High unemployment, low growth rates, continued financial crisis in Europe. So why is the U.S. stock market having a terrific third quarter? Is there something fishy happening on Wall Street? I'm Allen Barton. Stand by for Front Page. Joining me on set, Terry Jones, Associate Editor of Investors Business Daily, and Doug Altner, Analyst and Instructor at the Ayn Rand Center for Individual Rights. Okay, gentlemen, economy stinks. Stock market, fabulous. Terry, what's going on?
Is that your Joe Piscopo impersonation?
Yeah, exactly. I'm trying to get more elemental here.
Well, I'll tell you what's happening. A lot of people are wondering about this because they say, well, if the economy's so bad, why is the stock market feeling so good? Well, there are two things. One, there's an old saying in the stock market climbs a wall of worry. While everybody else is worried and frightened about what's going to happen, there are a number of people in the stock market who always will take advantage of the situation to snap up bargains or what they see as bargains. And that's exactly what's going on now. But the more crucial thing here, I think, that's happened is the Federal Reserve's policy of zero interest rates and quantitative easing, which has put so much money into the banking system and driven interest rates so low that it's encouraging people who ordinarily would not like the risk in the stock market right now to invest in the stock market. Because if you're only going to get 1 or 1.5% on a treasury bond, you might as well go into the stock market where you might be able to get 3 or 4 or even 5% from a stock yield on a dividend. So this has been a very carefully crafted plan and strategy on the part of Bernanke in collusion with President Obama to basically jack up stock prices, create a wealth effect before the election, and make people think they're better off than they are.
Doug, what do you think in terms of this idea of stocks versus bonds? I mean, Greenspan has mentioned that the idea of that bonds are now currently unattractive because of the yields. And so that's why people are going to stocks. What's your analysis of this?
I agree with much of what Terry says. I don't think we should view a rise in the prices of stocks as any sign of genuine prosperity. Central bankers are so active today where I think markets are more just responding to them than necessarily anticipating increases in actual value of businesses. So Bernanke's been telegraphing QE3 for a while. Maybe a lot of people just wanted to buy into the stock market, hoping that they'll be able to ride the initial response early on. So I think it would be a mistake to view the rise in the stock market as any sign of prosperity.
Bill Gross, the founder-in-chief of PIMCO, had this to say about the U.S. economy in his most recent outlook. Gross writes, quote, "If we continue to close our eyes to existing 8% GDP deficits, then we will begin to resemble Greece before the turn of the next decade." Gross also went on to state that the future amount of U.S. debt was, quote, "budgetary crystal meth," unquote. You gotta like a good...
Dude.
there you go. Thank you, Mr. Gross. Terry, what do you think of what he's saying here?
Well, I hate to agree with him, but I do. He's exactly correct. We have basically put ourselves on the path to fiscal ruin here. 8% of GDP deficits, but it goes up to 11% when you add entitlements. And over the next 75 years or so, we're going to have we have a hole in our budget of $76 trillion. Yeah,
but $1 trillion isn't what it used to be.
It really isn't. It really isn't.
In the old days, $1 trillion.
They just increased the limit on my credit card to $1 trillion.
Yeah.
So I'm thinking, well, that's really nothing.
What the heck,
Yeah.
Doug, obviously the candidates spoke a lot about deficits on Wednesday night's debate, although it's just sort of like trillion here, trillion there, we cut $1 trillion, we're at $1 trillion. They're just sort of bopping back and forth with this generally between 0 and 4 trillion. We've cut, we've expanded, we're growing, we're revenuing, we're cutting, we're spending, we're investing. And it's all within this kind of 0 to 4 trillion number over 10 years. Is it the last 10 years? Is it the next 10 years? It's kind of purposely vague the way they throw it around. But what do you see in terms of the real structural deficit problem as Terry is mentioning?
Well, I think a lot of why they want to create it as vague is so that way they want to mask the fact that they don't have anything substantial to say. Like Ayn Rand described presidential candidates of often very carefully saying nothing, and that's what I think is what's going on here. I think they should be talking more about QE3. Ben Bernanke is essentially playing with fire here. He's enacting the same kind of inflationist policy that I think created the financial crisis. It runs a risk this could easily get out of control. It could really destroy the value of people's savings by devaluing the dollar, and it could cause another financial crisis. And he likes to think that he can be really scientific about it. He says if he sees any warning signs of this, he could pull money out of the system in 15 minutes. But we need to recognize it's not as scientific as he thinks it is. Say he's monitoring price levels to try to see if the dollar is losing its value. But the problem is he doesn't know what the price level should be. We should be seeing prices declining due to great increases in productivity from technology and international trade. So we don't know how far they should be going down. But the Fed's trying to counteract them anyway. And so he really doesn't know how to prevent any kind of massive destruction of the value of the dollar or how to prevent another financial crisis. And so he's playing with fire here.
Terry, I want to follow up on what you mentioned earlier, the idea that Bernanke and Obama, or at least Obama's guys, are acting in collusion for a political benefit, that Bernanke may be wanting to keep his job over there, and he knows that if Obama's reelected, he keeps his job. Do you really think that's the case? Obviously, Bernanke says, look, I'm only making these decisions based on what I see in the economy at any given moment. But obviously, a lot on the right are saying that there's a game being played here.
Well, yes, and I think it's highly suspicious that QE3 was announced in September at a time when it would have maximum political impact. I think it's also, it's interesting. I don't think of Ben Bernanke as being, whom I've met, as being a highly political person, but I do believe he's he's cognizant of the political surroundings in which he operates, and he knows that he has to please both the president and Congress. Well, Congress is one half controlled by Democrats, and the White House is controlled by Democrats. And so I think he's playing the game right now. But I think it's a very dangerous game because everywhere the government's hand goes, you see distortions, market distortions. We're talking about the stock market. Stock market, we don't know these are the real prices because we have so much Fed money printing going on. We don't know that these prices are real, reflect any sort of underlying fundamentals at all. We don't know that housing prices reflect any fundamentals because the hand of government is so strong in them.
Well, yeah, I wanted to pick that up and bring Doug in on housing because housing indicators are improving thanks to QE3. But it's sort of what's interesting about what you guys are both bringing up is that we're seeing prices move up and down and indicators up and down, not based on any market value, any activity that is encouraging or discouraging, but purely based on what I'm sure you'd say the central bank just messing around. So, I mean, are people actually getting mortgages because of QE3? Because it seems as though the banks are sort of saying, we've found religion on the idea that you actually have to have income to get a mortgage. So all of this money is being stored at the banks, but not actually going out into the economy.
Yeah, I think a lot of commentary on this amounts to, well, the problem is that people aren't getting enough loans. There's not enough credit flowing. What can we do to get more credit flowing? But what this misses is that the whole financial crisis was created because too much credit was flowing. There was too many loans being lent out for interest rates that were too low for purposes that there wasn't really a market demand for. Like, so many people wanted to buy a house in a market that's not clear, and for people whose credit ratings were too low, and that was the real problem. And so it would be a disaster to have another kind of policy trying to stimulate more credit flowing in the same fashion.
Well, and the other argument that comes up with all this stuff is whether there should be congressional oversight of the Fed, and we've talked about this before. I mean, Bernanke recently gave a speech in Indiana, and he vigorously defended QE3, and Congress needs to butt out of the Fed, and that monetary policy shouldn't be politicized. So beyond the idea that you're offering the suspicion that it already is politicized because he's serving a Democratic master in the White House. But should there then be a countervailing congressional oversight? Because this is something that, obviously Congressman Paul is in great favor of. But what do you think in terms of a congressional counterbalance?
Well, there is already a congressional counterbalance, and Congress actually both regulates and oversees the Fed. He's called up by law twice a year to testify and tell them what's going on with monetary policy. So he's already basically under the thumb of Congress. If you're going to have a Fed, and it's an open question as to whether you need one or not. I mean, you can have just a market for interest rates and let it go. But if you're going to have a Fed, the Fed should not be beholden to politicians, and the Fed should have a clear rule under which it operates, and that clear rule would be price stability. And anything beyond that is impossible for the Fed to achieve, and therefore should not be part of its mandate. Right now, it has a triple mandate. price stability, higher maximum employment, and also stable interest rates. Well, we know those three, taken together, are impossible to achieve. And I'm not sure I would want to live in an economy where all those things were always in sync, no matter what. So, the fact of the matter is the Federal Reserve, if it's going to exist, should be as independent as possible. Studies have shown that independent central banks do a better job than central banks that are beholden to politicians. That said, Congress already does have some substantial control over the
Doug,
Fed.
maybe 15 seconds on, I know what you're going to say, but say it about what you think about the Fed.
Okay. Well, I think even if the Fed's independent, I've discussed before, I don't think price stability really works. I think we need to focus more on the other question that Terry raised, is do we really need to have a Fed? We've seen over the 100-year history, the Fed has created lots of financial crises. Studies have shown that there's more macroeconomic instability and banking panics in the period when we had the Fed than in periods before the Fed. And I think we need to start thinking about what can we do, because clearly this current system is unsustainable and very destructive.
All right, guys, good discussion. That's all the time we have for today. For Terry and Doug, I'm Allen Barton, and you've been watching Front Page.